Have you picked a company yet? Because I have the sneaking suspicion that there are a few of you who haven't yet. And of course, if you haven't picked a company, you haven't turned in your DCF or any feedback, which is perfectly okay because it's optional. But the project is not optional. May 13th, there is a project due. So if you haven't picked a company, for God's sake, come on. What are you waiting for? Revelation from a divine source somewhere? Just pick a company, right? And then get moving because it's running. Clock is running. You know what's coming next Monday? Quiz. Your third quiz. Just looks like you just took the second quiz yesterday, right? Okay, the third quiz is coming, which will cover all of pricing and a little bit of asset-based valuation and private company valuation. And then after the third quiz, you're going to go to hyperspeed because you're only a couple of weeks before the final project is coming due and final exams. All I'm saying is things are only going to get more and more intense if we've been putting them off. Okay? So let's start today's session by talking a little bit of pricing. I'm going to show you something very exciting. I have a slider, a pointer that actually works now. For 8 weeks I've been putting this off. That old pointer I had, there was nothing coming out of it. I kept pointing and clicking, nothing came out of it. I have a pointer that works, which is going to make a huge difference in my teaching. Because without the pointer, I was kind of lost. So pre-pointer, post-pointer, you can do the comparison. Let's do our start of the class test today. So today we're going to wrap up pricing. And we're going to come up with a variety of multiples. So we will look at price earnings, PEG ratios, price to book. And if you look at it, I'm going to start with the page. When you look at equity research, sometimes you'll have a dozen multiples sprayed at you. Sprayed is the right word because you really can't make sense of them, EV to EBITDA price. So you can estimate 10, 12, 15 different multiples for a company. And you can price the company with each one. So let's suppose you take your company, in this case Xyloft, a software company, and you apply a bunch of different multiples to price a company. Will they all give you the same pricing? No, price earnings can give you one, price to book can give you a second one. Remember your project though, what are you required to do? Give me a recommendation, buy or sell, which means much as you like to now pass this off, you got to decide. So I'm going to give you some choices on what you can do with these different pricings and the different numbers. The first is take an average across all of the different multiples. You could do that. You could take the multiple that most other analysts use in the sector, and you can take the multiple that best capture what investors are pricing assets on. After all, it's a pricing game. In which case, you got to tell me how you're going to make C, come up with C. And D, you can take the multiple that best incorporates the fundamentals of intrinsic valuation. Which do you think is the best solution? Part of you says, it should be intrinsic value stuff. We've been talking about it. Remember though, this is a pricing game. If I get a chance, I'm going to show you how I priced Twitter in 2013 at the time of their IPO. I didn't price it on revenues, operating income, growth rates, margins, even though all those things were. I priced it on the number of users it had. You know why? Because I looked across social media companies that were publicly traded in 2013, and I looked to see which variable best explained differences in pricing across companies. You think, how do you come up with that? I just did a correlation between revenues, EBITDA, etc., and pricing. And the variable that best explained differences in pricing across social media companies was how many users you had. That is, you're saying that is so irrational. Hey, your job in pricing, you took me down this road. Remember, I wanted to stay with intrinsic valuation. You said, let's let the market in. You decide to do that, you've got to trust the market in this. The answer actually here is the multiple that best captures the pricing differences, which means if you have a multiple and a bunch of variables, here's what you should do. Do a correlation matrix on it. See which variables best explain pricing. And if it's the weight of the CEO, maybe companies with fat CEOs have higher price earnings ratios, just go down that route, right? You're saying that makes no sense. If that's what's pushing up price, fire your thin CEO and replace him with a fat CEO and see if it actually makes a difference. Pricing is a very pragmatic exercise. It's not what you think and what I think that matters. Incidentally, you know what your valuation of the week this week is going to be? It's going to be Uber. I just posted my Uber valuation and pricing yesterday. I want to focus a little bit on how do you think I priced Uber? I priced it based on Lyft. You know how I'm going to price Lyft? Based on Uber. I'm going to price Uber based on Lyft. This is going to be the self-referencing game, which means what so Uber hoping and praying does not happen between now and their IPO. If Lyft has too many days like last Thursday, remember they dropped 10%, Uber is sunk. So I read this conspiracy story about how people in Uber were trying to talk Lyft down, and I said, that makes no sense, because if you're Uber, you have more than anybody else vested in how well Lyft does. You're going to talk them up. You're not going to talk them down. So it's a pricing game. But here's what I want you to do. Tomorrow I'm going to post the Uber valuation. It's already on my blog. I'm going to post it. I'm going to create the same Google shared spreadsheet I've always done. I want you to actually try the Uber valuation. Incidentally, I took a different twist in valuing Uber. Rather than valuing it with revenues, I did that, the top down, which like I did Lyft, but I also valued an Uber rider and built up from it. Take a look at it because it shows you how flexible discounted cash flow valuation is, how it can be adapted to... What's the value of an Uber rider? If you wanted to value an Uber rider, how would you do it? What do you need to do? Come on. You take an Uber rider, not an Uber ride. We know how much the ride costs, right? So that's pretty easy. But how much would you value an Uber rider? How would you do it with discounted cash flow valuation? With discounted cash flow valuation, if I asked you to value a rider at Uber, so help him out, what are you going to start with? The life of the rider, good. You're going to start with the expected life of the rider, then you're going to project out the number of rides, and not just the rides, but how much they will pay, and then you'll project out the expenses. So you come up with cash flows every year for, 15 years. Along the way, you got to take care of the fact that there's a retention ratio that riders might leave, and you project out the expected cash flows in the rider. You discount them back at a cost of capital of perhaps a safe company because the riders are already there. You come up with a value. I came up with a value of about $480 per rider for Uber. How many riders does Uber have? You guys weren't reading the prospectus all weekend? That's what I thought you were doing. Right? It's about 91 million riders. 480 times 91 gives me about $44 billion. We've got the existing riders nailed down. Am I done? No, Uber keeps adding new riders, so I've got to value a new rider. So what's the difference? If I value an existing rider as 480, what's the extra number I need to get a value for a new rider? Cost of acquisition of a new rider. It's about $120 right now. It's actually $113. I come up with about $360 or $370 as the value of a new rider. What's the other piece of the puzzle to value new riders? I'll have to estimate how many new riders I think Uber will add on. In my story, I have the number of riders going from 91 million to 214 million. I value the new riders. I come up with about 60 billion. Am I done? Not quite. Because there are some expenses not associated with riders, like the G&A costs, the R&D costs. I can't just leave them and ignore them. I'm going to take the present value of those costs. And I'm going to subtract them, and I come up with the value for Uber's operating assets. Am I done? I have to add cash. Not just the cash they have on hand, but the $9 billion they're going to get on the IPO. That's $15 billion. There's a risk of sounding like a broken record. Am I done now? What in the case of Uber do I have to deal with that I did not have to when I was valuing Lyft? I'm sorry? Uber Eats is already in my revenues. To me, Uber Eats is actually an extension, much as they'd like to make it seem like a different business. You know why we use Uber Eats? Because we're too busy, too lazy to get in a car and go pick up the food, so we use Uber Eats. So it's like an extension of ride sharing. What am I missing? It's a so I can bring that in, right? It's a cost of capital issue, so that I can bring into my discounted cash flow valuation. So that should already be in my DCR. What did Uber do in the last 2 or 3 years? They left big parts of Asia. They first left China. They left the entire Chinese market to Didi, and in return, what did they get? They got 20% of Didi. Then they left Southeast Asia, and they got 23% of Grab. Then they left Russia, and they got 38% of Yandex Taxi. It's only a matter of time before they leave India and get some percentage of Ola. Why did they leave China and Southeast Asia and Russia? Because they were burning through too much cash. But you see what's created for me in my valuation? Now after I value Uber, what do I need to do? I need to value Didi, and I need to value Grab, and I need to value Yandex Taxi. Using what? Nothing. I mean, if you thought Uber was opaque, you should see Didi. This is a company, the only thing we know about it, it can burn through cash like no other entity on the face of the earth. We know nothing. But we know it's worth something in there. So I took the number of net revenues of these companies and estimated a value for those cross holdings. I added that on and I subtracted out the debt and I came up with a value of equity for Uber of about 60 billion. Both approaches kind of converged, which actually puts me well below the 100 billion that people are rumoring about the IPO. I got a call from CNBC this morning asking whether I'd show up this week, and I said, don't even call me. The last time I showed up, I got all kinds of blowback from people I don't want to hear from after the Lyft fiasco. So here's what I'd like you to do. I'd like you to take my Uber valuation and come up with the value of Uber and put it in the Google shared spreadsheet. And if you look at the spreadsheets, I compute a median valuation. So when I show up on CNBC, and I promise I'd be back next week, you know what I'm going to give as the value for Uber? I'm going to give them your valuation. This way, if something blows up, it's not my fault. It's your crowd valuation that does it. I need somebody else to blame in case something catastrophic happens here. So give it a shot, because this is in the news. If you can value Uber, in the next interview, you have something really interesting to talk about. Kraft Heinz. People will fall asleep while you try to tell your story. Nobody buys that melted cheese that says melted for eternity. I know, and why would anybody buy it in the first place? But Uber is a fun company to value, so give it a shot, make it your story and your valuation. Final word of question. Let's say that you do an intrinsic valuation of Zoloft. You come up with a value of $10, and the stock is trading at 15. It's undervalued, right? You do a pricing of Zoloft using other software companies and PE ratios and come up with 20. So you have two different judgments. So based upon that, you would conclude the stock is undervalued, the stock is overvalued, the stock is correctly valued, the stock is both under and overvalued. How would you explain this? Sounds like a really tough thing to get away with, right? Because your intrinsic value says it's undervalued, your pricing says it's overvalued. Should we even use that word with pricing? It's overpriced, right? It's undervalued and over. Can a stock be both undervalued and overpriced at the same time? Absolutely. Because you're making two different judgments, right? When you're saying something is undervalued, you're saying given its cash flows, growth and risk, I'm paying too much. And when you're saying it's overpriced, you're saying given how the market is pricing other stocks. Yeah. So if Uber goes public at 80 billion, it could be both overvalued and underpriced at the same time. Do you know why? Because it's over, if your value is like mine, they're over 60 billion. But relative to Lyft, if you apply the net revenues, its pricing should really be 100 billion. You think, what do I do with that? What's your final decision on your project? You got to tell me whether you want to buy or sell. And your stock might very well end up like this. Which one are you going to hang your hat on? Depends. Depends on what? And it depends on you, right? Your holding period, your psychology, what you thought about your own. Remember, as you sat through the intrinsic valuation, you might have thought, this is all crap. I'm just making up stuff as I'm going along. It's good-looking stuff, but it's crap anyway. All of those things will play out in that final decision. So if you make a buy decision based on the pricing or a sell decision based on the pricing, I'm not going to push back and say that's wrong, because you had to make the choice that reflected who you were. So get ready for that, because that's the final phase of your project, is pricing your company and comparing it to the current price to make your judgment on what to do. So let's go back to where I left you. Last Wednesday. Remember we were talking about pricing? And we talked about different, I was a naive or an incompetent equity research analyst putting out all these recommendations, and you kept shooting me down. So I got fired as a beverage analyst and a telecom analyst, and a European banking analyst. But I always managed to land on my feet. Now I'm a market analyst. I look at large market cap companies. And here's what I've done. I've taken the price to book ratios against returns on equity of the 100 largest market cap companies and graphed it there. So each of those little points is a company. And you think, why are there three lines? The middle line is the regression line. You know what the other two lines are? They're the 90% confidence intervals. So one way to think about this is if your stock falls between those two lines, you cannot reject the hypothesis that it's fairly valued. But let's take this graph and think about what this graph tells us about underpriced and overpriced stocks. So there are a few companies that are below the line and there are a few companies above the line. First, easy question. Which is my underpriced group? The ones below the line or ones above the line? You got a 50-50 shot. The ones below the line are my underpriced. Let me list the three and you tell me where the red flags go up. So if I believe the pricing, ConocoPhillips, ExxonMobil and Nokia all look underpriced. What's the red flag? Two of my three cheap stocks are oil stocks. What am I regressing? I'm looking at price to book versus return equity, right? Price to book is of course what the market cap is today. Return equity reflects the earnings in the most recent 12 months. So give me a story that explains why oil stocks might fall below the line. I'm sorry? Basically, the oil prices have come down. Guess what? The market brings down your market cap, but your trailing 12 months reflect a very different oil price. When you do pricing and you find something to be underpriced, remember it's the start of your research, not the end of your research. So in this case, you might say, hey, ConocoPhillips and ExxonMobil, there's a reason why they're below the line, so even though they look cheap, I'm not going to buy them. Who knows? With Nokia, you might look at it and say, you know what, I'm going to do a full-fledged valuation. This was, of course, when Nokia's base market was melting down, right? The smartphone business was leaving them. But you can see why you have to be careful about following through. Let me go above the line. What are the three stocks that show up as overpriced? Google, Infosys, and Gilead. You know what they shared in common? They were all high growth companies. You're saying, so what? When I do price to book versus return equity, I'm missing the growth dimension completely. High growth companies should trade at higher price to book ratios. So the bottom line is when you look at this graph, there's some interesting things that show up, but there are so many things you don't control for. In particular, growth and risk. Is there a way I can take, this is a scatter plot, right? I can take the scatter plot and bring a third dimension in. Have you seen three-dimensional plots? They're kind of dizzying. Right? This is a three-dimensional plot. It's like having a cardboard box in front of you. I'm going to ask you where in this box my cheapest stocks are. Ready? First, you want low price to book or high price to book? You want low price to book, low return equity or high return equity? High return equity, low growth or high growth? So basically you're looking in this corner. There's nothing there. But are you surprised? What are these? The 100 largest market cap companies. But if you try this on 100 really small companies that are likely followed, who knows? You might find something in that corner. In fact, the closest I get to that corner is Time Warner. It's probably not even that underpriced. So that brings in growth. But the other thing I'm worried about is risk, right? So now tell me in this box where my cheap stocks are. So I have price to book, return equity, and beta. So I want low price to book, I want high return equity, and I want a low beta. So I'm looking in this corner of the box, and the closest I get is ExxonMobil. It's actually a fun way. This takes about 5 minutes to do with Capital IQ. You can take your sector and draw two-dimensional graphs, three-dimensional graphs. Can you do four-dimensional graphs? Kind of tricky. I think you've got to be Einsteinian to be able to do it. But if you want to go beyond just three variables, in other words, I have two independent variables, then basically you have no choice but to run a full-fledged regression. It's not as visual as running these scatter plots, but basically what I did was I took this group and I took the price to book ratio for companies and regressed them against beta, growth, and return equity. When you run a regression, you always check the R squared, which is pretty good here. You also check the T statistics. You remember enough statistics to tell me what I'm looking for? What am I looking for? A high T or a low T first? Let's get that out of the way. You want a high T statistic. How high is usually the cutoff point in statistics? You want it to be? Above 3 is asking for a huge amount. That's like 99% confidence. Above 2, you're pretty good. So in this case, you can already see that beta is there, but it's kind of going along for the right. One suggestion, when you run these regressions and you find a coefficient that is not statistically significant, it's better to take it out. It's pure noise. Because if you leave it in, you'll get a prediction, but the prediction will actually be less good. So what does this allow me to do? It allows me to see what matters and what doesn't. I'm letting the data tell me what matters, not what I would like to see. And I can use this regression to then tell you, out of the 100 stocks, which 10 are cheapest and which 10 are most expensive, right? I can plug every company in, then what? I can start a one-person hedge fund. I can buy the cheapest, sell the most expensive, then hope and pray what happens. They all move to the regression line. You don't make money if you don't converge. You've heard of quant models in hedge funds? What we're doing is very basic statistics. Imagine hiring 3 MIT grads coming in with powerful models and how much more statistics they can bring. I'm not saying the easy way to make money, but that's what quant models do, is they take the data and they milk it to its nth degree. Okay? Sometimes over the edge of what they should do. But essentially you're getting a peek at what a quant model tries to do. So let me give you an update on price to book ratios at the start of 2019. So this is the 100 largest market cap US stocks, price to book against return equity. What's the only stock that falls below the line? Verizon. Don't do anything crazy. Like liquidate everything you own and buy Verizon stock. But there's something off about Verizon, right? You know how I use these screens? If I want to do intrinsic valuation, I can't start with A and work all the way through Z. Too many stocks to work with. I'm intrigued, let me put it that way, by Verizon. Maybe taking a closer look at its, somebody in this room must be doing Verizon, right, for the valuation? Hey, I know you are. I'll find you, don't worry. Right? And I'm going to look at your valuation, and then I'm going to it wouldn't be right to base it on your valuation. I'll have to make my own story and my own valuation. But that's how I think these screens can help by isolating. And if I trust this graph, what are the most overpriced stocks in the market? Mastercard. Amazon, Netflix, and Mastercard. Amazon and Netflix have been above the line every year for the last 10 years. Which means if you go and sell short on Netflix saying, you know what, I'm expecting convergence, you would have been bankrupt already. But that's something to factor in, is you have to be careful about what you do with this pricing. Okay? Mastercard is interesting. That I don't know why it's so high. Again, worth looking at, right? So maybe that's something that you should factor in. I know that quite a few of you, maybe 5 or 6 people in this class are valuing Square. And if you think about Mastercard, it's actually in the same space, so it'll be interesting to see where that pricing leads you. So I got fired as this big company analyst. I land on my feet again. Now I'm the trucking analyst, incredibly boring sector. But let me put out a buy recommendation again. The stock I'm going to ask you to buy is Ryder Systems. You familiar with Ryder? So these moving trucks you can rent. And why do I like it? It's trading at 2.8 times EBITDA. That looks incredibly low, right? So if you were asking me questions about Ryder Systems, it could be cheap, but what else would you like to know about Ryder Systems before you put your money on it? Do you remember the variables that drive EV to EBITDA? One is risk, so you're saying. And let me put your mind at rest. These companies are all about equally risky, similar cost of capital. What else? Growth, they're all mature companies growing at about the same rate. You could probably ask about tax rates, because high tax rate companies are... Debt, and none of them, Ryder Systems is not hopelessly over-levered. That's a good question though, because if it's hopelessly over-levered, we're worried about survival risk. So I could give you ratings and debt, doesn't look bad. It's starting to look like we should put our money in Ryder Systems, right? Let me give you a little bit of insight into how this business works, and maybe you can ask me a final question. In this business, companies don't reinvest. They have fleets that they replace. Rather than replace a portion of the fleet every year, they replace their entire fleet every 6, 7, or 8 years. So if you look at their CapEx, here's what you look at. You look at a huge CapEx and no CapEx for 5 years. Huge CapEx, no CapEx for the next 5 years. So ask me the final question. How old is Ryder's fleet, right? And at the time that I did this analysis, it had the oldest fleet in the business, which means if you go out and buy Ryder expecting it to be cheap, or thinking it's cheap, the day afterwards you're going to open up the Wall Street Journal and discover a story that Ryder just raised $10 billion to buy more trucks. I actually pulled this recommendation right out of an equity research report. You know what the sad is probably too strong a word. The disappointing thing about this report is trucking companies actually report the age of their fleet as part of their annual reports. All that the analyst had to do was have another column in his Excel spreadsheet, and he'd have caught it. Remember I said, there's no problem with pricing. I don't have a problem with pricing. I have a problem with lazy and sloppy pricing. And so much of pricing, people don't dot their I's and cross their T's, and they think things are underpriced just because they trade a low multiple of EBITDA or earnings or book value. So, fired from that job too. Okay. I now land on my feet. I'm now the grocery store analyst in 2007. Grocery stores are perhaps the most boring companies on the face of the earth. They have tiny margins, they have no growth, there's not much to do. And when I plot grocery stores, they all fall in the line, except for, what's that? Who's that? Whole Foods. Whole Foods is trading like it's on another planet, right? It's trading at this huge multiple of revenue. So if this were 2007 and you're an equity research analyst and I pushed you on Whole Foods and you tried to explain it, what would your explanation be for why it trades at such a high multiple of revenues? What is the variable that drives revenue multiples? Growth is always a variable, but revenue multiples, a key variable is what kind of margin do you have as a company? You see the story you're going to tell me? Whole Foods margins are much higher than Kroger's or any other grocery stores. Therefore, they should trade at a high multiple of earnings. Well, that story is definitely true, but should they trade at 1.41 times earnings? Revenues. So here's what I did. I took grocery stores. I did a regression of price to sales against net margin. I know price to sales is not completely consistent, but let's stick with that. And I came up with a predicted price to sales ratio for Whole Foods, given its higher margin. And I got a predicted price to sales of 0.43. So even with the higher margins, it should be trading at 0.43 times revenues. It's trading at 1.41. It said I'd had the guts to actually sell short on Whole Foods in 2007. This is Whole Foods in 2009. Same sector. Where's Whole Foods now? It's actually one of the most underpriced stocks in the sector. It went from most overpriced to most underpriced. In fact, in 2009, its price to sales ratio was down to 0.31. Its predicted price to sales was 0.36. It went from being overpriced to underpriced. You think, finally, market's coming to its senses. This is 2010. What's happened to Whole Foods? It popped back up to above the line. The market's being a little manic depressive with the stock, right? And you know why that's happening? If you look at investors in grocery stocks, they have inertia. They do things the way they've always. It's worked with other grocery stores. They did not know what to do about Whole Foods until about 5 years after Whole Foods got established. By 2012, Whole Foods was actually on the line. Finally, it made it to the line. Because finally, people had their arms around, okay, we know what it does. We know this. It has slightly higher margins and slightly lower turnover ratios, but it took them 5 years to get adjusted. And I'm going to show you one final graph of this. This is 2015. Now Whole Foods is part of the established status quo. Notice that there's a new player in town now? That's Sprouts. I shop at Sprouts every week. And it's actually it's a much smaller version of Whole Foods. A lot of stuff they just go out of stock and they never restock. They don't seem to care that much now. But it's different now. And Sprouts should not rest on its laurels too long, because 5 years from now there'll be a new kid in town again. It takes a while for markets to adjust to new players entering, especially if they're disruptive players. And that's an opportunity. Do you see why it's an opportunity? Because while the market is trying to figure out how to price these companies, if you can get a little ahead of the game and start to attach a story and a value, you might be able to take advantage of the market confusion. Do markets know how to price ride-sharing companies yet? I don't think they have the slightest idea. They will not next week after Uber goes public either. Maybe after Didi and Grab go public, and after they watch these stocks for about 4 or 5 years, they'll finally figure out the right way to price them. But during that period, if you can start to think about what it is that drive the value, maybe you can get a little ahead of that pricing game. But during that period, you're going to be frustrated as a value investor because the price can go wherever it wants to based on mood and momentum. So I'm fired again. So here's my final job. I'm the .com analyst. I couldn't find any other jobs. And now I've learned my lessons. I've seen what I've done in all the others. I ran a scatter plot, right? That scatter plot seemed to work well. So I said, okay, I'm no longer going to pick stocks based on just the level of the multiple. I'm going to run a scatter plot of .com stocks in early 2000. So I put up the scatter plot and my stomach drops. Do you see why? I have a scatter plot, but it looks like a shotgun blast. If I try to fit a line through this, I have no idea what the line's going to look like. But undaunted, I decide to run a regression anyway, because that's the only thing I know, price to sales against margins. And I get an R squared of 4%. Are you surprised? It really. But here's even scarier now. Look at the coefficient on net margin. It's negative. How would you read that? The more negative your net margin, the higher your price to sales ratio. If you're writing a book on irrational exuberance, this could be exhibit 1. Look how crazy people are. The more I lose, the higher my market price. You could start a contest. You lost 2 billion, I can lose 3. You can lose 3, I can lose 5. So if you were a cynic, you could say, this is crazy. Investors are crazy. Investors are irrational. But when you do pricing, the words irrational and investors should not cross, because you're trusting the market. You can't selectively say, I'll trust it when I like the investors and I don't. There is always order in markets, even in the midst of chaos. There's a reason why, even in the midst of chaos, investors put prices on companies. You might not like the reasons. So let's step back. If you go back to early 2000, the peak of the .com boom, and you're an investor looking at a .com stock, were you buying it because of how much money it made last year? I hope not, because it lost a lot of money. In fact, if you're buying Uber or Lyft, are you buying it based on earnings last year? I mean, Uber's operating loss was $2.5 billion. Why are you buying it then? You're buying it for revenue growth. You're also buying it on the hope that it survives. And let's face it, the larger a company gets, the lower the multiple you can afford to pay. With a dollar company, you can pay 100 times revenues. So here's what I did. I took the price to sales ratios of the .com stocks in my sector, and I ran a regression against the log of revenues. You're saying, what's the log of revenues doing? I'll give you a little trick. When you run regressions, you're assuming linear relationship between the variables. To the extent that relationships are non-linear, putting a log in seems to get rid of it. I know there are lots of transformations, so if something doesn't work, put a log on it, magically the variables will become more linearly related. The higher the revenues, I'm expecting the lower the price to sales. As revenue growth goes up, I expect the multiple to be higher. And I threw in how much cash the companies have. You're saying, why do you care? You know how with the young companies, what you worry about a lot? Will they make it? You know how young companies choose not to make it? It's they run out of cash. So if you accumulated a lot of cash, your chances of survival. So think of this as a proxy for survival. The T statistic on revenues is actually marginal. I should take it out. But I left it in and came up with a predicted price to sales ratio for Amazon in January 2000. And I came up with a predicted price to sales of 30.4. It was trading at 25.6 times revenues. So basically it looks underpriced. But I don't know whether you remember, but about 2 sessions ago, I did an intrinsic valuation of Amazon at the start of 2000. A DCF, remember that? And I came up with a value of 35. The stock was trading at 84. So in my discounted cash flow valuation, my conclusion is Amazon is massively overvalued. Don't buy it. And as an investor, I'd hope you take that advice. But in this analysis, what am I saying? Given how other .com stocks are priced, Amazon looks underpriced. And both those conclusions would have been right in hindsight. Because here's what happened in the year after my intrinsic valuation. What happened to Amazon's $84 stock price? It dropped to 11. It dropped about 85%, but it dropped only 85%. You say, what do you mean only 85%? You know how much the pricing in the .com sector collectively dropped by? 97%. If you drop only 85%, you're a hero. That's the thing about pricing, is you're not getting the cheapest stock, you're getting the least underpriced stock in the market. It's a different philosophy. Nothing wrong with that. You just have to walk in with open eyes. Now the other thing you can do with young companies is remember why you're running into trouble. You're running into trouble with young companies because there's not much there, right? The revenues are small, the losses are big. So here's the other tactic. Rather than divide by the earnings today, you can look at an expectation of what your earnings will be 5 years out or 10 years out. Okay? What does that give you? It gives you more substance. So rather than divide the revenues by sales, the market cap by sales, the market cap by EBIT, or market cap by net income today, you project out. It's called a forward multiple. Again, be clear about why you're doing it. You're doing it because you don't trust today's numbers to have any substance. The one thing you have to be careful about is what will happen. So if you apply that forward multiple, you usually apply to revenues in year 5 or 10. And you've got to be careful about what's going to happen to that value as you move it back across time. A few years ago, I valued Tesla, and I came up with a terminal value of 69 billion. But my actual DCF value was only 15 billion, and people were puzzled. If you're getting a $69 billion terminal value, how come your value today is only 15 billion? So I actually did a post on what happened between the 68 to the value today. So first, I adjusted for time value, which is 69 billion today, would be worth only 52 billion. So just discount back pure time value, risk-free rate. Then I said if I put in a risk factor, it's going to, so the 68 billion will become 28 billion just in the process of discounting back at the cost of capital. You're saying, why am I still losing money? Well, so remember that to get to year 10, I've got to provide cash flows. And if Tesla is a growing company, I have negative cash flows in years 1 through 5. That present value of the negative cash flows knocks down another $15 billion in value. And then you get the 12.8 billion, there's a chance of failure, you got to adjust for that. And then if you have debt and cash and options, by the time I was done, my value was down to 8 billion for the equity. 68 billion terminal value becomes 8 billion in value today. I'm putting that out as a cautionary note. If you apply a forward earnings for your company and you apply a multiple, it might look big. But when you think about all the adjustments you got to make to get it back today, don't be surprised if a $250 terminal price becomes a $15 value price per share today. So if you use forward multiples, keep that in mind. And this is the Twitter example I talked about, which is let the market tell you what matters. So this was when I had to price Twitter in October of 2013. I went looking at the market to see what the market was pricing. So these are my social media companies. There's a market cap that I got. I pulled up a bunch of variables, EBITDA, revenue. I wanted to see what mattered in that. And I also threw in the number of users. And I computed enterprise value multiples for each. But I went back to my statistics because I wanted to see what the market was pricing in. Why was the market cap different? And here's what I got as my, remember, have you ever done correlation matrices? So remember, the correlation, if it's 1, is perfectly correlated. So ignore the diagonal because that's correlation against each other. Take the market cap and look across the different variables, right? So market cap and enterprise value obviously are very highly correlated because they're measuring the same thing. Revenues, the correlation is 0.89. EBITDA, it's better. Net income, it's back down. But the highest correlation I got was with the number of users. You're saying, what are you going to do with that? 98% of the variation in market cap across these companies comes from the number of users they have. If you look at the average, they're paying about $100 per user in the median value. So let's say you are the investment banker taking Twitter public. You run this analysis and you're trying to put a pricing on Twitter. We could do a DCF valuation Twitter, but your job is pricing. How would you price Twitter? First, if I'm Twitter, what's the question you're going to ask me? How many users do I have, right? I have 240 million users. Then what? Market's paying about $100 per user. What's 240 million times 100? About 24 billion. That's it, you're done? That's it, you priced Twitter, and that was actually very close to the opening price for Twitter. I did a DCF value, you know how many contortions I had to go through on cost of capital and discount rate? I could have just taken the number of users and multiplied by 100. And in fact, this is actually a good way to think about why Facebook bought WhatsApp. I remember when Facebook bought WhatsApp. Yeah. You remember what Facebook paid for WhatsApp? How many people in this room have WhatsApp? Okay. How many people pay for their WhatsApp? Okay. This is, you pay for your WhatsApp? What's wrong with you? You pay that $1?
$1 a year, no?
You don't have to. You can get it for free. So you've been paying $1 all this time, you poor sucker. No, it's okay. You get. This was true. I remember when WhatsApp was bought for 19 billion, I would do this. In Asia especially, WhatsApp has always been big. In India it's huge. 400 million Indians are on WhatsApp. And I'd go to a room and say, how many people? Well, 1 out of 100 would put up their hand. And poor guy like you. Like $1 something a month. The revenues were almost non-existent. There were, of course, huge operating losses. And the big question then was, why would Facebook pay 19 billion for a company with very small revenues and lots of losses? And I actually wrote, this remains the most read blog post that I've ever written, where I tried to explain it. I said, look, what's Facebook buying with the 19 billion? About 450 million users with very little overlap over the Facebook users, because many of them are in parts of the world, especially Asia and Latin America, that Facebook did not cover. Let's say 350 million are unique users. How much is the market pricing a user at? $100 per user. So how much should you be willing to pay for 350 million users? About 35 billion. In a strange way, in a very perverse explanation, you could argue Facebook got quite a bargain at 19 billion. I'm not sure why Uber bought Careem. You heard Careem is the Middle Eastern ride-sharing company. But I wouldn't be surprised if that number in the riders pops up and look, we added 8 million new riders. The fact that you will never make money in the Middle East seems to be completely irrelevant here. But that's the name of the game in pricing, is you're just going for whatever the market will pay. Now let's close the pricing section by saying, okay, what if I want to expand my sample? Because so far I looked at the beverage sector, at the trucking sector, but I stayed sector focused. Why not price companies by looking at everything that's in the market? The problem with staying within a sector is sample is always small. There's so many more stocks in the market, right? Your first reaction is, I can't do that. Why not? Because there are differences in growth and risk and cash flows across stocks. You're right. But what does a regression allow us to do? Control for differences in growth and risk and payout. If I can control for those differences, I've essentially expanded my sample to include every stock in the market. So at the start of every year, I do this. I take every stock in the US. I do this for every part of the world, but I start at the US. And I said, let me take the price-earnings ratio for every US stock and regress it against growth, because I keep getting told that higher growth companies have higher PE. They're like 1,500 companies in the scatter plot. Don't try to count them because they're all on top of each other. You can already see something when you look at this plot, which is that the relationship between PE and growth is not that strong. The good news is there is some positive relationship. Bad news is there's a lot of noise. The next thing I did was I wanted to explain differences in PE across US stocks. So I ran a regression of PE ratios. This is across all US stocks at the start of 2019 against 3 variables: beta, growth, and payout. You know why I picked those 3, right? Remember when I did the algebra on an intrinsic valuation model? Those are the 3 that popped up. I throw those 3 in. First, I get an R squared of 49%. Good R squared, bad R squared, or it's what it is. It is what it is. If I'd got 15% there, you know what I'd have said? PE ratios are really difficult to explain. What the heck are you doing using PE ratios in the first place? Again, this is not my weapon of choice. I want to do intrinsic valuation. You drag me into pricing. All I'm doing is holding up a mirror to you and saying, do you really want to use this multiple? 49% is one of the higher R squareds I've got for US stock PE ratios. So I'm okay with that. The coefficient I get is minus 12.70, which means, remember, you don't control the data. Every 1% increase in growth rate increases my PE ratio by 1.40. So we're getting somewhere. That's what you'd expect. Along the way, I'm checking the T statistics. They all look tremendously significant. Every increase in my beta 1 increases my PE by 10.5. Okay, let me get this straight. You're a higher beta stock, I give you a higher PE. That doesn't make sense, right? Intuitively, as risk goes up, you'd expect PE to go down. Don't do anything stupid by saying, hey, that plus should be a minus, I'll just put a minus in front of it. This is the data. In this data, it looks like higher beta stocks have higher P ratios. The data is what it is. And finally, the higher your payout ratio, the higher the P. So high R squared. But two troubling factors. One is the intercept is negative. The second is that beta seems to have the wrong sign. So I started thinking, why does beta have the wrong sign? Do you remember in your statistics classes when you ran that multiple regression, one of the conditions that the statistics professor imposes on the independent variables, what's supposed to be true about the relationship across your independent variables in a multiple regression? They're supposed to be uncorrelated with each other, independent, or if you really want to be, they have to be orthogonal to each other. I don't even know what that means. But the independent variables are supposed to be, do you think there's any chance that beta growth and payout ratio are going to be independent? What tends to be true? High beta stocks tend to have high growth and low payout ratios. And in fact, when you look at this relationship, it's clearly, in fact, when you get correlation across the independent variables, statistics has a name for it. It's called multicollinearity. It doesn't mean you cannot run the regression, but it does mean that the coefficients on your regression start to get a little shaky. Second, when you have this regression and you use it to price stocks, remember you're assuming that this regression you got by looking at the current data will hold as you go over time. That's it's called a stationarity assumption. So we're assuming that things are predictable, that they will return. So here's what I'm going to show you. I'm going to show you first what I did about the negative intercept problem. And it's a problem because here's what happens. If you have a big negative intercept like you did here, and you use this regression to get predicted PEs, you might actually get a negative predicted PE. And that's a problem. And it's an easy fix. If you're using any statistics package, including Excel, you can actually turn off the constant. You can force the regression through the origin. Basically, you make it's an easy fix. It makes your regression actually a worse regression because the line doesn't fit as well anymore. But you basically replace the constant with a zero. So that's the first thing I did. I took the constant out of the regression, gets rid of my negative intercept. On the second one, there's not much I can do because the reality is when I take a look at beta, payout, and growth, these numbers, see these points, they should all be zero, but they're not. I have 0.254, 0.168, and if you see the two stars, you can actually see that high growth stocks tend to have high payout, low payout ratios. There's a relationship between risk, payout, So what's happening in the regression is the computer is getting really confused. When you put in the beta column, it doesn't know whether beta measures risk or whether beta is standing for growth. It's actually acting more like a growth proxy than a risk proxy. So that's part of the reason the coefficients don't make sense. So if you were to use the PE ratio regression, here's what you would do. You would take, for instance, a stock like Disney, take the growth rate, the beta, and the payout ratio, and plug it in. And if you plugged it in, you get a predicted PE of 26.8. So it started 2019. If I plugged in Disney's numbers into that regression, I get 26.8. Let's say it's actually trading at 25 times earnings. It is underpriced or overpriced? It's underpriced. It's underpriced by about 10%, less than 10%, 8%. And you can see how powerful, because I can use this regression to get the predicted P for every stock in the market. I mean, I wasn't kidding when I said you can be a one-person hedge fund, but you're putting your trust on that regression equation working. But you can basically use this as a way of telling me very quickly. So we have like 2 minutes to make a decision. Is it underpriced or overpriced? You can take the market regression, plug your numbers in. Let's say that you price Disney against now just entertainment companies. So I've concluded that Disney is underpriced relative to the market. Now I price Disney against the entertainment sector. Am I going to get the same judgment that I got when I priced it against the market? Why not? Because I'm comparing to a different peer group. You can have something. That's like, asking you whether you're fat or thin. It depends on who you hang out with. You hang out with the Overeaters Anonymous, you're probably going to feel really thin. You hang out with people who can't eat at all. I don't know what the equivalent on the other side is. You're going to feel really fat. So that's basically what's happening in pricing. And depending on who I compare you to, I can come to very different conclusions. And here again, you'll have to decide. Because you could price your stock against the market, you can price it against the sector, and even the sector you can define differently. You can be against domestic stocks or global stocks in the sector. And you can very quickly come up with very different pricing judgments. So I took that P ratio regression and I focused in on the coefficient for growth. At the start of 2019, that coefficient was 1.40. What is it telling me? Every 1% increase in growth increases my PE by 1.40. And I've been keeping track of that coefficient now for a really long time. In this table, I've gone all the way back to 2000. You can see the number goes up and down. So that's what the market is willing to pay for growth. Remember when we did implied equity risk premiums, what we call them? That's what the market is charging for risk. You see, so what? Go back to the start of 2000, peak of the dot-com boom. What's the market doing? It's paying a huge amount for growth and not charging very much for risk. So if you're a high growth, high risk stock, this is nirvana for you. You get this huge PE ratio because I'm not punishing you for being risky and I'm rewarding you for growth. That same stock, 1 year later, take a look at what's happened. The market's paying much less for growth, demanding a much higher implied equity risk premium, and as you go through from 2000 to 2004, you're going to say, what the hell happened here? I'm the same high growth stock and I'm the same risk, but your PE ratio is going to be much lower in 2004 and than it was in 2000. And that's one of the reasons, if you're going to do this pricing, it's got to be current. You can't take the 2009. In fact, I can't even use the January 2019 numbers to do a pricing today. Why not? Because the market is up about 15%. I'd probably have to rerun the regression with today's PE ratios if I want to make predictions. It's got to be about today. It's got to be pricing today. I tried this on PEG ratios. So I took PEG ratios and did a scatter plot against growth rates. And I know that I'm going to have a problem with linearity. You see why? Take a look at that graph. There's that, no, I know it's kind of difficult to do, but there seems to be a kind of a curve on it. So here's what I'm going to do. I'm going to take the log of growth, and remember it seems to magically work. It's still a scatter, a shotgun blast, but now it's more likely to be linear. So when I ran my PEG ratio regression, here's how I ran it. I ran it against beta payout and the log of the growth rate because that's more linear. Again, R squared of 18.7%, am I happy with it? No. What is it going to tell me? Don't use PEG ratios, nothing more I can do. But I can tell you as beta goes up, PEG ratios go up. As payout ratio goes up, PEG ratios go up. And as growth goes up, PEG ratios decrease because the growth is in the denominator. Again, I can use this to make predicted PEG ratio calculations. The coefficient is positive, so I don't have the same coefficient problem that I had with PE ratios. But here again, I'm building up to the regression by first checking the data to make sure that I can attach a linear regression to it. Now, thing I pointed out earlier. So if you look at the coefficients, especially the log of growth rate has a t statistic that's negative, take it out. It's much nicer, much cleaner to run the regression with only the variables that matter. Okay? Some of you, when you price your stock, you have access now. What is Minitab? What's the statistics package that Stern offers free downstairs? I think it's Minitab or SPSS, or there's so many packages, right? In fact, if you want to get SPSS, now is the time to do it because you get a student discount. So if any of you are graduating, you don't want to pay the full price on that thing. Right? It's a nightmarish cost. Spend the money, get a good statistics package. Because if you're dealing with data, it's nice to have the tools at your disposal. So I do this for every market, and I won't bore you because what I do for the US, I do for Europe, Japan, emerging markets, Australia, and then I do a global regression. Think of how many stocks there are in my global regression. And I do the same beta, payout, and growth, and for some of the markets you might see one of the variables drop out because the t statistic is not significant. But you can notice even across markets, PE ratio did pretty well. And then once I'm done with PE ratios, I move to price to book, and I do the same regressions. What's different is now you'll see ROE pop up in every regression. Why? Because it's a variable that showed up when I did my DCF. These are not kitchen sink regressions. You know what kitchen sink regressions are? We've all been guilty of them in statistics classes. Well, what's the end game? I want a high R squared, otherwise I'm going to fail the class. So you start throwing things that improve your R squared. That's not my end game here. I want to explain things with the things that matter. And if I can't explain them, I'm just going to leave them out of the regression. EV to EBITDA across markets again. Different markets. And you notice again that R squareds have become dramatically lower. EV to EBITDA multiples, in spite of the fact that so many people like them, are really difficult to explain across companies. And finally, EV to sales regressions. You can see the R squareds are a little better than EV to EBITDA, but again, a lot of noise. But the variable that pops up with EV to sales is operating margin. So if you go to my website, you get the start of 2019 regressions. I don't want you guys spending a lot of time running regressions for the entire market. It's not worth the hassle. It takes too much time. But it's not difficult to do. You just have to dump it into a data set. You've got to clean up the data. That's what takes time. And then you've got to start running regressions. The SPS says you can run regressions with 43,000 companies. The problem in Excel is it's remarkably inflexible, right? I think all the independent variables have to be in columns next to each other. It's kind of a pain in the neck. That's why I like a statistics package at my disposal. And you get a lot more neat options that you can turn on and off to see what happens. And EV to invested capital, key variable that pops up is the return on invested capital. So there's really nothing you're learning by my hitting you with these pages, but notice the variable that pops up with each. That's your companion variable. That's the variable that best explains it. So across, again, different regions and the globe. So let's summarize the pricing game. When you sit down to play the pricing game, you have some choices to make. First, you got to tell me what you're going to scale, what market cap, what market value. You can take market value of equity, which is market cap, market value of the firm, or enterprise value. You got to tell me that. Second, you got to tell me what you're going to scale that market value to. Your choices are to be revenues, earnings, cash flows, or book value. Third, you got to tell me whether you're going to use current numbers, trailing numbers, forward numbers, really forward numbers. And finally, you got to decide in your peer group. Which one's the right one? In pricing, there's no such thing as a right pricing. If you control for the variables, you can use any multiple you want. But you can already see the judgment calls you got to make. And making those, here are some of the things you might want to look at in making your choices. So as you sit there saying, which multiple should I use? Think about the choices you have and think through what you're going to find most appropriate for your company. So let me close off with a few propositions about pricing, which I've kind of been dancing around, but might as well be upfront. When you do a pricing, you're not telling me a stock is undervalued or overvalued. You're saying it's undervalued. No, let me take the word valued out. Underpriced or overpriced relative to whoever you compare it to. It's a relative statement. Second, there are no perfect comparables. Let's put that on the table. So if you're trying to price something, whatever you try to price it against will be a little different than you, or a lot different. You have to figure out ways to correct for those differences. I used regressions. If you don't like them, come up with something creative, because you can't just tell me stories. So relative valuation is pricing, not valuation. And we have to remember that when we apply these multiples. So define, describe, analyze, apply. I've been pretty religious with every multiple. So if you break the process down, there's no mystery to pricing as long as you're careful about checking along the way for what you have to control for. Any questions on pricing? So let's take a detour. We've done intrinsic valuation, we've done pricing. We're going to come and talk about valuing private companies and option pricing and valuation. But I want to talk about an approach that some people claim is an alternative to discounted cash flow valuation or pricing, even though I don't think it is, which is valuing the assets of a company. It's called asset-based valuation. So the asset-based valuation, here's what you do. Rather than value the company, you value the pieces. So if you're a multi-business company, you value each business. If you're in multiple geographies, you value each geography, and then you add them up. Most of the time, though, when analysts talk about doing sum of the parts valuation, which is what this is called, they actually are doing sum of the parts pricing. That sounds mysterious, but I'll talk about why. I think it's more pricing than valuation. But the reason I don't think of asset-based valuation as different, or a different way is to value the assets. You can either use discounted cash flow valuation or you can use pricing. It's not a different way. It's an application of both approaches, but it's not an alternative to them. So think about when you might want to value the assets of a company. The first is if you're called in a liquidation. Because what are you going to do in liquidation? You're going to sell the pieces for whatever they're going to get. You have to value the individual pieces. The second is, much of fair value accounting is about putting numbers on the pieces of the company. You actually have to value divisions and assets. So if your job is an accounting job, you might have to value the pieces. And third is, if you're a potential acquirer of a company, you want to break the company up, you might actually want to see what the value of each piece is to decide first whether it's worth buying the company, and second, which pieces you want to sell off. So there are times when you have to do some of the parts valuation. But remember, to get the value of the parts, you can do intrinsic valuation, you can do pricing, or you can trust the accountants and use the book value. If they have to take one out of the equation, I'd say take the third one out, right? Because it is the least reliable. So ready? I'm going to actually talk about applying this for companies, but I'll tell you when it's easier to do asset-based valuation. It's easiest to do asset-based valuation when you have separable assets. You're a real estate company with 7 different real estate properties. Let's say you're a hotel company of 7 hotels. I can value each hotel separately, add them up. They're separable. But if you ask me to value Disney in its pieces, much messier, right? Because if they succeed in the Avengers movie, the theme parks do well. The lines are grayer. It's much more difficult to do a sum of the parts valuation of Disney because I'm not even sure the theme parks can survive on their own without the movie and the broadcasting business feeding into it. Second, it's nice if each piece has its own earnings and cash flows because I can do a full-fledged valuation. And if you can't get that, it'll be nice if there's an active market for other assets just like yours. That's why real estate is so easy, right? I can take each piece and say, hey, there are other properties that have sold recently. So the company I'm going to value is going to allow me to do all of these things, but let me do a very quick visit of all of those other missions. If you're valuing a company for liquidation, first remember, you probably should not be valuing the company, you should be pricing the company. Why? You're selling it in the market today. What the heck is an intrinsic value going to tell you? So first, your mission is a pricing mission, so you should probably price the assets. And then remember, because you're doing a liquidation, if you're in a hurry, what do you have to do? You have to settle for less than the fair price. You might have to attach a discount on your value because you want to get rid of those assets quickly. So liquidation valuation, I'm not sitting there doing DCFs and doing gymnastics. I don't have the luxury. I'm just going to do a pricing of the assets and maybe attach a discount to it. If I'm doing accounting valuation, I think first we've got to deal with this oxymoron called fair value accounting. About 15 years ago, when the accounting rules were being written, I remember getting a call from the rule writers at the GAAP rule writers saying, will you come in and talk to our panel? They're writing the fair value accounting rules about how we should approach it. And I said, do you have the right gut? You do know what I think about accountants, right? And they said, we've heard. But we'd like you to come and talk to us anyway. So I said, can you send me what you view as your mission? And they sent me this thing called FAS 157. It still is the defining set of rules on fair value accounting. And as I read FAS 157, I got more and more confused about what the end game here was. Because what FAS 157 tells accountants to do is attach a number to assets and liabilities that market participants would be willing to pay today. You read that mission. Is that a pricing mission or a value mission? That's a pricing mission. Fair value accounting is really fair price accounting because your job is to attach it. So it's clearly tilted towards pricing, but here's the problem. The accounting rule writers who wrote the mission also require accountants to do a DCF to back up the number. Do you see how unfair this is? I'll give you an example. Fidelity owns a piece of Uber. And the rules now require accountants to come in and re-estimate the value of Uber for fair value accounting. And they have to use a DCF to justify it. So about a year and a half ago, I get a call from the accounting team that was working on this number, and they said, we're stuck. And I said, what are you stuck on? They said, we know what the pricing for Uber is. There had been a VC transaction recently. It was about $62 billion. They say, we know what the pricing is. We own 1% of the company. 1% of 62 billion is 620 million. And I said, okay. They said, but we have to do a DCF to back into the 620 million, and there's nothing we're able to do to get even close. What are we missing? And I said, you're not missing anything. You're trying to use the wrong tool for the wrong job, and it's not your fault. It's built into fair value accounting. If I were to rewrite fair value accounting, first I'd call it fair price accounting, and I'd ban the use of discounted cash flow valuations. Why? Because it's pricing. What the hell are you doing projecting cash flows and discount rates? It'd make our lives all easier, but the frustration this is creating for accountants around the world was predictable. You can't give people a fair pricing mission and then task them to turn in a valuation, an intrinsic valuation, to justify the pricing. And finally, there is sum of the parts valuation. This is for transaction. You value the different parts. And here you could make an argument that you have to do valuation because you're going to have these parts, perhaps you're getting them for the long term. You're thinking about what the cash flows will be. But when you're talking about sum of the parts valuation, you can also talk about sum of the parts pricing. So essentially you can do both. So if I have to do a sum of the parts valuation, I need information on the different parts. So I'm going to take you through a valuation I did of United Technologies, which I used to describe as the poor man's GE. But now it's actually the rich man's GE because it looks a lot better than GE now. But the reason I picked United Technologies is it actually is in very different businesses. So if you look at their businesses, Carrier's refrigeration systems, Pratt & Whitney's defense, Otis is elevators, so construction, UTC Fire and Security, Hamilton Sunstrand in manufacturing, Sikorsky's aircraft. Very different businesses, and they actually break down information by business. You see why this is going to help? Because if I'm going to value each business, I need the breakdown. They just don't give me revenues. They give me revenue, EBITDA, operating income, CapEx, depreciation, total assets. The company also had corporate expenses, and this is almost like an afterthought, of $408 million. So that's expense for the company. They can't trace it to any of the divisions. So first, I'm going to try to do a discounted cash flow valuation of each of the parts. So help me out here. For each of the parts, if I want to do discounted cash flow valuation, I have to first come up with cash flows. Oh, first let me do the pricing. That's going to be easier. Let's do a pricing. If I'm going to do pricing and it's naive pricing, here's what I'm going to do. I'm going to take the EBITDA for each of the businesses, which is given. I'm going to take the average EV to EBITDA for other companies in the sector. When analysts talk about doing sum of the parts valuation, this is what most of them do. This is what I call the pricing you do at the end of a dinner after you've had too much to drink. And somebody says, what do you think this company is worth? You pull up an envelope, you write in the back of it, and I think it's worth 16 billion. It's incredibly sloppy pricing. Why? I'm taking the average EV to EBITDA, so I'm not controlling for differences between I'm using the same multiple, EV to EBITDA for all six companies. But to the degree that I buy that, the value that I get, it should really be called a pricing. The sum of the parts pricing is 61.66 billion. That's a very naive pricing. Now what could be more appropriate? Well, I could look at different multiples in each sector. Remember I said there's some multiple that works better in some sectors, and I actually picked in each group different multiples based upon running regressions within each sector and picking the one that has the highest R square. So EV to EBITDA works in about 2, EV to revenues works in about 2, EV to invested capital works in about 2. I've run the regressions and I plug in the values, and the R squareds are actually pretty decent. So here's what I do. I take the numbers for Carrier and I plug it into the regression. I get a predicted EV to EBITDA or EV to capital or EV to sales, and I get the estimated value. The difference here is I'm picking, think of this as more sophisticated pricing. It's still pricing, but I'm trying to pick different multiples and adjusting for differences. The pricing that I get is about 74 billion. So file that away. 61 billion was the naive pricing. Why is my pricing higher when I adjust? Maybe it's got higher margins, better runs, so all those pieces come into my pricing. So if I were doing pricing, that's what I would do, is break the pieces down and do it. Last year when I valued GE, I also priced GE. I valued GE as the sum of its parts. I priced GE as the sum of its parts, essentially using a variant of the same approach. Now let's talk about it. Oh, incidentally, in those two pricings, there was one loose end that I left dangling out there that is going to be a problem. I took each division's EBITDA and multiplied by a multiple, or even in the sophisticated approach. What am I missing? Where do those corporate expenses go? I just completely threw them away, right? I acted like it was all waste. That's an incredibly cynical view of corporate expenses. Anytime you do a pricing and you miss that, you are going to find your stock to be underpriced, even if it's not. Why? Because that expense is an expense I've got to bring in. There's not much I can do with pricing, but when I do my DCF, I'm going to be careful about bringing those expenses in. So here's what I did next. I decided to do a sum of the parts valuation, not pricing. To do a sum of the parts valuation, I essentially did everything we've done in traditional valuation, came up with a reinvestment rate, a growth rate, and a cash flow. So if you look at the numbers I've used, I started with the cost of capital for each business, doing a bottom-up beta, different debt ratios, and I came up with different costs of capital for different businesses, which actually is something we've talked about. Then to do the valuation, I came up with the numbers I need for valuation. And you can see that the businesses vary wildly. Pratt & Whitney is a very, very high value creating business. But if you look at UTC Fire and Security, it actually is pretty, in fact, I think their cost of capital is 6.78%. They're actually making 6. There's some value creating businesses in here and some value destroying businesses. And because I've split them up, I can treat the businesses differently. So when I do my cash flows, I'm going to use these as my driving forces. And actually, because I'm valuing each business separately, I'm no longer required to use the same growth period. Some of these businesses are mature, some have high growth. I can treat them each differently. I can give each of them a different cost of capital. I can value growth differently in each business. It's just more flexible, DCF. It's a lot more work though, right? Because I could have just valued United Technology as one big company. But here I'm getting values for each of the pieces. Sum of the parts valuation is a lot more work than most analysts would be willing to do. That's why they do sum of the parts pricing and that very sloppy pricing. But what I've got here is essentially the numbers. And if you look at the value of cash flows, I've got the value, present value. So think of this as the value of the operating assets of each of the 6 businesses. I get a total value of 80.25 billion. Before you use that though, what's the last loose end again? 408 million. Is there a way I can bring that into the analysis? Yeah.
Just assume those expenses grow at some ratio.
And in this case, that's what I did. This is a pretty mature company. I assumed it was growing at a stable growth rate. Applied the cost of capital for the whole company on it, and I came up with a present value of 4587. You know what I'm going to do with the 4587? I'm going to reduce my value today by the 4587. I get a value for the operating assets. So here's where I am. The value of sum of the parts DCF is 76 billion. The sum of the parts sophisticated pricing gave me about 74 billion. If I just value the company as a company-wide DCF, I'd have got about 71 billion. The actual enterprise value is about 52 billion. I didn't buy United Technologies after this. But this is actually in one of my papers called Valuing the Octopus, because these are companies in multiple businesses, multiple geographies. And we traditionally have taken the shortcut of valuing the companies as one big company. But there is an advantage to breaking it down into its individual parts. And there's my GE, the sum of the parts valuation. And if you look at the numbers, I'm doing exactly what I did with, I'm sorry about the ugly colors, but I should have changed them. But essentially you can see the cost of capital vary widely across businesses. And I'm going to try to value each business separately. And the value that I got for each business is actually the sum. So in this case, GE Capital was actually a value drainer. The value that I got for GE Capital's operating assets was well below how much debt they owe. You know what that means? If somebody walks up to GE and says, will you just give me GE Capital? GE Capital says, here, take it. As long as you take the debt with you. Okay? This is a business that is unsellable at this point. It's more liability than asset. It's a negative value. You can't extricate yourself from it. You know why? A lot of the GE Capital is? It finances the GE aircraft. So their stars are actually entangled. This is, I think, the most difficult part of GE that to deal with if you're the CEO. But you can see the parts play out. And if I did a pricing of the parts, basically I applied a multiple. Again, very sloppy multiple. I can do a pricing for GE. And here's how it played out my decision. I found GE to be undervalued with a DCF. I also found it to be underpriced. And that made me feel better about my undervaluation. Why? I'm going to buy based on the undervaluation, but the fact that it's underpriced means I have two forces working in my favor, right? If I make money, I'm not counting only the money I made because the valuation came through. If the pricing pushes, if it's mood and momentum, what do I care? I'm still making the money. So what you're capturing in a pricing is perhaps a timing advantage, that maybe you want something to be both undervalued and underpriced to jump on, which means we shouldn't make this an either-or proposition, right? Because people say, are you a believer in intrinsic value or do you want to use multiples? I use both. My first belief is in intrinsic value, but why should I turn away multiples if they can help me time my investment better? So let's stop there. When we come back on Wednesday, we're going to talk about valuing private companies. How are you?
Very good. I'm a student from France actually, and studying finance in Paris. And we all, like, all of the students follow your classes.
Good.
So we're just here to take bags and alumni from our Mastercard.
Okay.
And
I'm glad you made it to class then.
yeah, I'm very happy. Like,
Thank
you
you.
so much.
You're welcome.
Plus are actually
Do you hear that Notre Dame is on fire?
is going
The cathedral is on fire.
Yeah, the cathedral looked like yesterday.
Yeah.
Yes, I saw that.
So you're from Paris too?
Yeah, we are.
Currently from Singapore.
Okay. And US? Which where?
Business finance.
And yeah, and all of us are applying for investment bank, so I got into JP Morgan this summer.
Congratulations.
So I don't know if
In London or here?
London.
Okay.
I don't think you can apply directly to
Because of these
New York.
differences.
Yeah, we need a visa, you need to study, I think.
So London still be in the EU when you go there in the summer? Will London still be in the EU when you go in the summer?
hope so. I mean,
You
the
might need a
Brexit-
visa to go to the UK. I don't know.
I need a visa anyway, because
Okay.
I'm Moroccan.
Ah, okay. So you need a visa pretty much everywhere in the world. Right? I've always wanted to go to Morocco, so one of these days I'll. No, I'm supposed to be in Cairo and Beirut doing two valuation seminars sometime next year. So maybe I'll make it to Morocco. I'm getting pretty close.
And sir, do you have any tips for us?
For your investment, you got the job now, so
Just for summer internships,
yeah.
not like graduate.
It's still. I mean, remember, internships lead to jobs, right? 80%. Don't try too hard to impress. Just be yourself.
Yeah.
And I think that what you're there to learn is the things you like doing as well as the things you don't like. So keep your senses open to what you don't like doing, because that's going to play out in what your final job is. So,
Well, thank you so much.
okay, take care. Good luck. Take care. Hello there.
Pastor, I sent you my TCF.
Yeah.
I sent again last week.
I'll try. I'll check again. You put the minus my perfect DCF in the subject, right? Yeah, otherwise it's going to get lost. I'm getting like 300 emails a day. I have no idea. So send it again and put my perfect DCF in the subject, okay? Hi, how are you?
I sent you a few emails because we won't be able to attend the quiz because of religious holidays.
I'm sorry?
I sent you a few emails because we won't be able to attend the quiz because of religious holidays.
No, for next week I'm going to give people an option for the Jewish holiday. You can take the quiz with my MBA evaluation class the next week.
Okay.
So it's a week from Monday. So basically next Monday is your quiz, but the week from Monday is the MBA evaluation quiz. So you can go to 260 and take that quiz. And on top of your quiz, just remember to write, just put undergraduate class.
Thank you so much.
So what I'll do is, and it's the same materials, we're doing exactly the same thing in that class. So
Should I email you also?
No. Basically, I'm going to email it out to the entire class so people know that they have that option for the Jewish holiday.
Is everybody allowed or just people who have the
Only for the Jewish holiday. Why would you want to take? No, I can't allow everybody that option. That would not be right. I mean, it's
You have to try at least. I just had a quick question. So
Yeah.
you know we covered a lot, like some material in the first lecture slide, the first two classes.
yeah.
Is that also going to be on the quiz on Monday, or is it just going to be?
No, it's not. No, the quiz is non-cumulative. It's only since the second quiz. It's only pricing.
So like after the second quiz,
Right.
remember we covered from like 306 to 353 in the first PowerPoint.
Oh
slide?
yeah, there's not. It's all, but most of those was pricing anyway, right? It was an introduction to pricing. So basically, it's about why value and price are different So there's nothing there that I can really ask you that would be specific.
Okay, so just basically number
Pricing, yeah. It's
two.
really
And it's going to
packaged.
be the whole PowerPoint, right?
It will be until pretty much the end of private company valuation. We'll be done with private company valuation next class, or will be enough done that will be through private company valuation.
All right, thank you.
Okay. Hi, how are you?
Is in town and asked me if I could
What's the name?
Ingmar, ING.